5 year-end mistakes that will trigger an IRS audit and how to fix them before December 31st. December is your last chance to fix mistakes that could trigger an IRS audit next year. Last December, I helped a client avoid a potential $8,000 tax penalty by catching one simple mistake with 10 days left in the year. Today, I'm sharing the 5 most common year-end mistakes that put targets on business owners' backs and how to fix them before it's too late. Hi, I'm Bev from bookkeepingcoach.net, and I've been helping businesses through year-end for over 30 years. The IRS looks for specific patterns when selecting audit targets, and most business owners have no idea they're creating red flags in their own books. These aren't complicated mistakes. They're simple oversights that can cost you thousands in penalties and audit fees. The good news? Every single one is fixable if you catch it before December 31st. Mistake number 1 is the big one: personal and business expenses mixed together. This is audit red flag number 1, and I see it in 90% of small businesses' books that I review. Here's what this looks like. Your business credit card shows charges for gas, meals, office supplies, and your kids' school supplies, all coded as business expenses. Or you're deducting 100% of your cell phone bill, but you use that phone for personal calls too. The IRS computers scan for this pattern. When your meal expenses are unusually high for your business type, or when your office supply expenses include personal items, you're creating audit risk. To fix this before year end, go through your last 3 months of business credit card and bank statements. Look for any personal expenses that were coded as business. Create owner draw entries to move those personal expenses out of business accounts. For mixed-use expenses like your cell phone, your home office, calculate the actual business percentage and adjust your deductions accordingly. If you use your phone 70% for business, only deduct 70% of the bill. Mistake number 2 is not preparing for 1099 reporting. If you paid any contractor $600 or more this year, you need to send them a 1099 by January 31st. Miss this deadline and you're facing $50 to $280 in penalties per missing 1099. But here's what most people don't know. You need the contractor's tax ID number and correct address before you can file. If you don't have this information, you have till December 31st to get it. To fix it now, run a report of all payments to contractors this year. Create a list of everyone who got $600 or more and contact them immediately for their W-9 tax form with tax ID and current address. Better yet, don't pay contractors until they provide a W-9. If a contractor won't provide their information, document your efforts with dated emails or letters. This protects you from penalties if you can prove you tried to get the required information. Mistake number 3 is expensing equipment purchases instead of depreciating them. This is a big red flag because it often overstates your business expenses dramatically. Here's the rule. If you bought equipment that will last more than 1 year and costs more than $2,500, it generally needs to be depreciated, not expensed immediately. Things like computers, machinery, vehicles, and furniture. I see businesses that bought a $15,000 truck and coded it as vehicle expenses. This makes their expenses look $15,000 higher than they actually are, which creates an unrealistic loss or understated profit. To fix this, review all your equipment purchases this year. Look for anything over $2,500 that you coded as an expense and move these to fixed asset accounts and talk to your accountant about depreciation schedules. There are some exceptions, like a Schedule 179 deduction that lets you expense certain equipment, but these require specific elections on your tax return. Don't just guess. Mistake number 4 is inventory valuation errors. If you have physical inventory, the IRS expects you to count it and value it correctly at year end. Getting this wrong can shift thousands of dollars between tax years. The most common mistake is not doing a physical count or doing a count but not adjusting your books to match. If your books show $20,000 in inventory, but you actually have $15,000, that's $5,000 difference affects your taxes. Another mistake is inconsistent valuation methods. You can't use the cost method one year and switch to market value the next without IRS approval. To fix this before year end, do a physical inventory count if you haven't already. Compare it to your QuickBooks inventory balances. Make any adjustments for any differences using the adjust quantity or value on hand feature. If you discover you've been tracking inventory incorrectly all year, work with your accountant to determine the right approach. Sometimes it's better to fix it gradually to avoid large one-time adjustments. Mistake number 5 is poor record retention. The IRS requires you to keep records that support your tax return. If you can't prove a deduction during an audit, they'll disallow it and charge you penalties. The standard rule is 7 years for most business records, but it's not just about keeping the records. You need to keep them organized in a way that proves the business purpose. I've seen businesses lose thousands in deductions because they had the receipts but couldn't prove the business purpose. A restaurant receipt isn't automatically deductible. You need to document who you met with and what business was discussed. To fix this before year end, create a simple filing system for your receipts. For any large or unusual expenses, add a memo explaining the business purpose. Take photos of receipts that might fade, like thermal paper receipts. Set up a digital backup system, scan or photograph important documents, and store them in the cloud. If the IRS audits you in 3 years, you'll be glad you did this. Here's your action plan to fix these issues. Week 1. Clean up personal versus business expenses. Go through your last 3 months of bank and credit card statements. Move any personal expenses to owner draws, and document any mixed-use expenses with proper business percentages. Week 2. Handle 1099 preparation. Run reports for contractor payments. Contact anyone missing tax ID information. Order 1099 forms if you're filling them out yourself. Week 3. Review equipment purchases and inventory. Move large equipment purchases to asset accounts. Do a physical inventory count if needed, and make necessary adjustments in QuickBooks. Week 4. Organize your records. Create a filing system for tax documents. Scan important receipts, and document business purposes for large or unusual expenses. The key is not to panic. These are all fixable problems if you address them systemically. Don't try to do everything in one day. That's how mistakes happen. Look, year-end doesn't have to be stressful if you know what you're doing and you start cleanup early. But if you're feeling overwhelmed by all of this, know that you're not alone. Most business owners weren't trained to be bookkeepers. My QBO Mastery course has an entire section on year-end procedures, including checklists for everything I covered today. It's step-by-step videos that walk you through exactly what to do and when to do it. If you're a business owner who wants help implementing these fixes, or you're a new bookkeeper that's not really sure what I'm talking about, my group coaching gives you access to me for specific questions about your situation. The links are below. Don't wait until January to discover you have problems that could have been fixed this year. Subscribe for more year-end tips, and I'll see you next week.